For more on this, we want to bring in Alicia Levine. She is head of investment strategy and equities at BNY Wealth. Alicia, this was what we thought was going to be a volatile week. A lot of important numbers that came in. We did see the S&P dip down by 5% from the all-time high. But if you blinked, you missed it because the markets took right back off on these cooler than expected inflation numbers that came through. Where do you see this kind of what trajectory does this put us on?
So I think we're going to get more of the same. You know, we think it's going to be a much more volatile year this year, really circled around policy and fears of inflation and fears of Treasury supply. So the bond market and the risk on the bond side is going to be driving volatility in the equity market. But having said that, the fundamentals are so strong and corporate, credit spreads are still tight. The fundamentals are good. We're looking for double-digit earnings this year. So we think the market ends higher. It's just not going to be a year of 56, new highs that we had last year, where it was sort of a steady walk upward. So more volatile, but fundamentals still strong. And coming into the year with, the S&P at a 22 times forward multiple, there's no room for error here. So you're going to get more involved regardless of what's happening in Washington. It's just you're a little bit more vulnerable to it.
I mean, is the stuff that's happening in Washington noise in terms of any potential spooking it does of the market? Because if you look at earnings, they've been pretty strong, too. So what do you follow? You can worry about the Fed kind of saying it's not going to cut rates anymore. They worry about the potential for hiking rates. You can worry about what might happen with tariffs or beyond. But there is some pretty strong positive things that are coming out of Washington these days. And if you've got earnings that are really backing that up, it seems like that would be what wins the day.
So, look, we focus on the fundamentals because there are headlines for everything. And essentially, the S&P is just a reflection of the strength of American companies. And we're there. We're in a world where it looks like the labor market is reaccelerating. It looks like, consumer spending continues to just tick upward on its trend line, regardless of the fact of higher rates, higher for longer. So you're just in a world where you have earnings, you have corporate credit tight, you have corporates with double-digit earnings, you have consumer spending. It's just a world where you can get around some of the policy issues because ultimately the fundamentals are fine for the market. So that's where we are. That doesn't mean it's going to be a peaceful year here, right? There is going to be volatility here. In an average year, the average drawdown is about 12%, even in years where you have double-digit gains. So we haven't had that in the last couple of years at all. Last year was 8%, and that was in a week. Right. Again, if you missed it,
if you blinked, you missed it.
You missed it.
Happened this week.
So, what investors have learned is buy the dip, and we had a 5% dip, and that was pretty good. And the other thing, and let's talk about where the market fear is. The market fear is all on one side, right? So you have tight positioning on inflation for longer. The Fed can't cut. Policies are going to be very difficult. And so it doesn't take much to get the trade to go in the other direction. And I think that's what we saw this week with CPI.
If you're looking at fundamentals, what do you like?
So in terms of sectors, we like industrials here. We do think policies that are going to be coming in of deregulation, more M&A, and favoring reshoring industrials win here. Financials, you can see from the earnings season, have been quite strong. Tech has lagged this week. I think it's a bit of a reset on valuations. I think tech still is fine this year, particularly communication services, so we like that here as well. So we just think it's a better year, better entry point. And I think there's just more of this focus on these points, CPI, Inauguration Day, 100 executive orders, right? Like there's this fear of these things driving the fear of actually jumping in. And once you get past that, we think we'll resume the upward trend.
What do you not like?
I think the staples are still in a difficult place, right? I think healthcare is really interesting here. It just can't get off the mat. And it just looks very difficult. That's going to be a show me situation. It's, I think, very difficult to invest there. Staples are very difficult. We're not in a market, we're not in an economy where those sectors can do well right now. We much prefer the cyclicals, as we spoke about financials, and we still like tech here. So that's where we would go, avoid the other sectors. Overall, we are exposed to U.S. large cap. We're neutral weight, medium and mid cap and small cap as well, because this is a kind of policy environment, deregulation, where those sectors can do pretty well.